This is the third video of the series Security Analysis and Investment. And in this video, we are trying to discuss capital asset pricing model. The goal of this model is to find the cost of equity. Cost of equity, what is that and how to calculate, we will see. Okay, so in the last lecture, that means in the last video, we discussed about risk and we talked quite a bit about firm specific risk and market risk. And we have seen that the market risk is known as systematic risk and it is undiversifiable, whereas the firm specific risk is unsystematic risk and it is diversifiable. And these two terminologies, unsystematic and systematic, I did not mention in the last video, but they are also used equally, like diversifiable and undiversifiable, same as unsystematic and systematic respectively. And so we used beta as our measure of market risk, and it was calculated using covariance between asset return and market return divided by variance of market return. This you have already seen in the last video using Excel spreadsheet, and if you have not seen that video, please go to this link in the right top corner and watch that video. So anyway, that is how we calculated beta value. And now let me tell you another thing, that the determinants of beta, that means suppose if a firm has a high beta or if it is having a low beta, then what is the underlying reasons? So basically there are three reasons. The first one is the financial leverage. What is financial leverage? It is the ratio of debt to equity. That means how much, basically if you see the total capital structure of any firm, so it can be divided into two sectors. One is your debt, that you borrow the loans from the banks or the financial institutions, or it can be the equity, that means the shareholding of the equity holders. So these are the two sources of capital, and the ratio of debt to equity is known as the financial leverage. Sometimes it is written as D by D plus E also. So it depends on the convention. But anyhow, this is the ratio of debt and equity, and more the debt, higher is the leverage. So this is one source of risk. Another source of risk is the nature of the business itself. That means the nature of the business the firm is in. That is one source of, major source of risk. Which risk I am talking about? I am also already told you that I am not specifically discussing the firm specific risk here. I am only interested in market risk here. So since the market risk is measured using beta, so these determinants are applicable to market risk only. So then the third one is your operating leverage. What is operating leverage? It is the ratio of fixed cost versus variable cost. So how much fixed cost is incurred and how much variable cost is incurred, the ratio of that, the percentages of that is the operating leverage. So these three factors are the determinants of beta. Okay. So now before developing the capital asset pricing model, we need to understand two or three concepts. First one is the risk-free rate. What is the risk-free rate? Risk-free rate is, suppose you are investing and you are not interested to take in any risk, and still you will not get zero return. That means conventional wisdom says that if I don't uh, take any risk, then my return should also be zero. But practically, if even if you consider zero risk possibility, there is a certain return. So you see the y-intercept here, the y-intercept. So this is not starting from this 0 point, this is starting from this point. So this much return anyway you will get. from the risk free rate. So that is called the risk free rate. So what is the source of risk free rate? So basically there are two criteria. First one is there is no default risk. That means basically primarily it is issued by the government, and also no intermediate cash flow. That means suppose it is a bond and you are investing in year 0, and the bond is maturing after 10 years, so year 10, then there should not be any intermittent cash flow in or out, right? So you invest once and get it after 10 years, so there is no possibility that you invest again in between and then the interest rate is something else there, or you take out money. No such possibility is there. So if these two conditions are met, then we will say that it is the category which is risk free, and the rate of return is risk free rate, also represented in terms of RF. And basically it is the government treasury bond rate of any government minus the default spread. Now what is the default spread? So for example, if you check the government treasury bond rate for say USA, you may get the bond using Moody's rating triple A plus. Suppose, I don't know actually what is the actual rate. I am telling you just for an example. But if you come to India, the same bond, same categories of bond will rate suppose B or triple B or something like that. So basically the reliability of the bond in the two countries are different, and therefore a default spread should be taken out from this treasury bond rate in order to calculate the risk free rate for any country. And for the countries which are having higher rating for the 10 years bond, the default spread should be very little. We will see that after some time. And then another concept is risk premium. What is risk premium? Suppose an investor is not satisfied with the risk free rate and he wants some more risk to take. So the return over and above the risk free rate for any asset that is having average risk is called the risk premium. So what is average risk? That means any asset that is having a return similar to the market or even the market itself. So it is possible to invest in Nifty also. Like for example, if you are investing in Nifty, that means you are investing in the market, and so the average that will be an average asset for you, and so that average asset return minus the risk free return, this particular entity, this will be called as risk premium. Plus, but please note here that it is not customary to first calculate the market return, then subtract the risk free return from that to get the risk premium. Risk premium for a country, risk premium for a country will be found using appropriate charts or tables that is already historically calculated. So we don't have to calculate the market return and risk free return and then subtract the risk free return from RM to get the risk premium. Risk premium should be directly found using chart. So how to do that, I will show you. So here it is. For 10 years bond rate, we will go to this particular link, and for the default spread and risk premium, we will refer to this particular link. So let me click here. So I am clicking it here. I will give you the link in the description box. Please use that. So first one is this. So as you can see here, this is the Bloomberg data. And for example, if I check it for India, so this is for India. This is the yield for 10 years government bond. So 7.29%. And what is the other link? Other link is for default spread and risk premium. So I will go to the Stern University website, and here they have listed down. So you will check the row for India. This is India. So you see, this is the bond rating BAA3. So for this bond rating, they are specifying that the default spread, this particular second column, this adjusted default spread column, that is showing you the default spread. So for BA3 type bond, rating bond, the default spread is 1.87%. So if it is a high uh, rating bond, for example, in Abu Dhabi, Moody's rating is AA2. For that, you can see that the adjusted default spread is quite low, 0.42%. But anyhow, let us check for the Indian bond only. So India BAA3, 1.87%. And what is the risk premium? Among this country risk premium and equity risk premium, you need to select the equity risk premium, because we are trying to find the cost of equity here. So this particular column you will refer, and for India this is 6.42%. So I have just noted this down. So here it is, 7.3% was the government bond rate, default spread was 1.87%, and therefore your RF is 7.3 minus 1.87, so 5.43%. And then the risk premium, this is the risk premium, this is 6.42% from the table. So this is how you will check from the table. Okay, so now what is the capital asset pricing model? So it is very simple, plain mathematics of 10 plus 2 standard. So in the x-axis we will plot the risk premium. This is the risk premium, and in the y-axis we will plot the expected return. This is the expected return of what? Of an asset I. So ERI, that is the expected return of an asset I. And this is the straight line relationship. Equation is expected return is equal to risk free rate plus beta into risk premium. So naturally, when your beta is 0, that means you are at the y-intercept, and your expected return value is now RF, that means risk free rate. And if you increase the risk premium, if you increase the beta value, then that means you are moving through this straight line, and for any non-zero beta you will have a particular straight line like this. So for a high beta value, this straight line will be like this, and for low beta value this will be like this. So this can be easily understood using this diagram. So now another thing is, so far we were discussing beta in terms of unlevered beta. That means we were using the slope formula, if you can remember the slope formula. Why slope formula? You can see this is the slope. In this straight line, beta is the slope. And so in the Excel sheet in the last video, we were able to use the slope formula in order to calculate the beta value. And if you plot this and get this beta value like this using regression method, then that will be an unlevered beta. That means, what is unlevered beta? Unlevered beta is beta unadjusted from the debt. So basically, if the percentage of debt in the capital structure is higher, that means the investment is also higher. So that kind of higher investment, higher risk investment should be also included in the beta value. So this beta value that we are getting from the regression result, that will not consider that inclusion of debt. So we need to calculate the levered beta. So how to calculate that? Using this particular expression. So this is the levered beta, this is the unlevered beta that we have calculated so far. 1 plus 1 minus t into dye. D and E I have already told you, this is the amount of debt, this is the amount of equity. Both are in terms of market value. Both are in terms of market value, not in terms of book value. And this is the marginal tax rate. What is marginal tax rate? How to calculate, how to find, all these things we will discuss after some time. But this is the definition, that you will first find the unlevered beta using the regression method or the slope formula or the covariance formula, and using that and this formula you will calculate the levered beta, and this levered beta will be used in case of this formula, that means the expected return of an asset. But in the beginning I told you that this capital asset pricing model anyway we were using for finding the cost of equity. So cost of equity. So note that we are calculating expected return of an asset. Expected by whom? Expected by the investor. So the investor will put his money in this company, and in return he wants some kind of return percentage, which is your this one, expected return. And so therefore this expected return itself is the cost of equity. Cost of equity means what? That means this company is getting fund or capital from this investor. What is the cost of that? That means it has to give it back to the investor in terms of expected return, and that should be this is the cost of equity. So if we are able to calculate expected RI using this equation and levered beta, then that means that is equal to our cost of equity. And then why we are calculating this cost of equity right now? Because you see, in the next video we will see how to calculate the weighted average cost of capital. So I have already told you that there are two sources of money, two sources of capital, debt and equity. So we must know the cost of equity that we will calculate from here, and you also must know the cost of debt, which is the interest rate, so combination of that in some method will give us to this weighted average cost of capital. How to calculate that and what is the purpose and how to use that further, that we will see in the next video. So until then, thank you for watching and goodbye.